Here we are, folks, once again, another live show. Welcome to everybody in the chat and enjoying some of the exchanges before we came on air. I'll just put the pre-show on for a moment or two. Hope everybody's well this evening and keeping one eye on the budget, which I'm just doing as well. $9.3 billion surplus in 23-24. Then we have an election. And then we have $28.3 billion deficit, 24-25, $42.8 billion deficit, 25-26. And so it goes on. Interesting, eh? Well, we might discuss some of that, but also I have Damien teed up ready to come in, of course, as normal. And we'll look at some of the broader market-related issues too. Just before I do that, just give you a bit of a view of the dogs. There they go. They've had their lunch. They've had their walks. They're now hopefully going to sleep through the show. unless the bin collectors come and rattle their cage. And just in terms of the studio, that's the layout. I've got Damien teed up ready to come in over there as normal. I've got the stream there. I've got the chat there. I've got the multi-view over there. And I've got my controlling computer for the system to stream it over the internet over there on my left. So that's all pretty much there, ready to go. And had a bit of an interesting little shock. I went to turn on my internet streamer, and the first time in about 6 years it didn't boot up. So I turned it off and turned it on again. It seems to be working all right. So the moral of the story is turn it off and turn it on again. Maybe we should try that with the economy. Oh no, we did that 2 or 3 years ago, and that didn't actually help much. Anyway, let's get rid of the pre-show, and I'll run the start of show, and then I'll be back in just a second. Well, good evening and welcome to this live stream on budget night. That's the 14th of May, 2024. If you're watching this in replay, it's Martin North here from Digital Finance Analytics. Great to have you on the show tonight. And live Q&A, of course, with Damien Klassen, who I'll bring in just a second. Just before I do that, I will just remind you, as I always do on these shows, that we don't provide specific financial or indeed legal advice. We do moderate the chat, but invite your questions, comments, and all of those good things. The chat gets quite busy. I don't necessarily follow all of the streams in the chat there. So if you want to get a question to me or ask a question of Damien, if you use that Walk the World, that'll get my attention. That gets into my separate queue. I've also enabled Super Chat, which means that you can get your question to the top of the list, or indeed make a contribution to what we do around here. We don't do this for profit. We do this because we think there were some really important conversations to be had. And I want to thank you for all of those who do support us via Super Chat or other ways, all greatly appreciated, and helps to oil the wheels of DFA to enable us to do the shows that we do. So with that done and dusted, let me bring Damien in, and hopefully he's all ready. And yes, he is. Damien, hello.
Hey Martin, how you going?
I'm very good. Welcome, welcome. Thanks for
That's
coming in
good.
on budget night, and we're
That's
going
all
to have
right.
an.
I almost tried to come in last week instead. So yes.
Yeah, no, it was interesting. Sort of coming in a week early, which would been good. And anyway, look, there's so much to talk about. Um, just a little bit of a question
Hmm.
as the budget's running. Do budgets really move markets, or is it really just a
No,
sideshow?
no, it's sideshow, and I think more and more over the last few years, we hear about pretty much all of it in the weeks before anyway. And so yeah, it's I mean, I do think there's an equation. I've forgotten. I was talking to somebody about this earlier on today, and I've forgotten the name of it. But there's an equation that sort of basically draws up three sectors of the economy in terms of saying there's the business sector, the consumers, and then you've got the government. And effectively, you can rework all the numbers so that when governments spend lots of money, it all ends up in the hands of higher profits for corporates. So if you are running persistent deficits, you can sort of see there is a longer term correlation between that. The flip side is it's also quite heavily. There's one more equation that's sort of in there, which is your exports and imports, and so that equation's a lot more true for a country like the US or somewhere that's not so as import export dependent upon as Australia is. And so I think in the longer term, yes, they make a difference for profitability in terms of saying, is there a big gain or loss in one particular sector, or I think is has been largely factored in by markets by the time it's announced, and you're never quite sure about as well how much of it is genuine and how much of it is just a spin that they're putting on. And so,
Spin,
yeah,
politicians
yeah,
spin. Yeah, and
exactly.
just on that, some of the housing support measures were actually ones that were previously announced and then were repackaged and re-announced. So some of the
Yeah,
state-related stuff, for example,
absolutely.
and of course the $300 support for households, all households this time, not just those in particular benefit categories.
Mm.
Um, well, presumably that means that the electricity industry can just charge a little bit more. And so, as one of the people said in the chat just now, the main
Oh,
winner will be the energy companies.
yeah, absolutely. And they're huge winners, regardless. So they seem to be very good at. We've had a few quite fortuitous timing issues, particularly in some of the power prices we've seen in New South Wales in the last week or two. In terms of the pushing prices up that sort of give you a month's worth of profits in a couple of days type thing, and so yeah, I think it is good policy in my view to smooth out some of the energy price changes for people in terms of subsidies and things like that. And I think what the Queensland government did was very good in terms of the coal, in terms of saying, yeah, we're going to put a higher royalties on coal to sort of tax the rest of the world. We're going to use those royalties to subsidise energy prices in Australia. And he said that's sounds like great policy to me. Um, the danger I worry about with what the Albanese government has done so far, though, is it seems to be that they're effectively taxing everyone else we're paying higher taxes in order to give subsidies to energy companies that are then taking that and selling the gas cheaper offshore. So yeah, I'm unconvinced that uh, while I think it will affect the bills a little bit, I think it's if you did all the numbers and worked out how much these guys are paying in tax and royalties and everything like that versus what the extra amount they're charging, I think the Australian taxpayer is going to be the net loser in the whole thing. Even though it might seem like you're getting $300, you've probably just paid $500 more in tax because of it. So
Yeah, and of course you also have the problem that if you do use those sorts of mechanisms to artificially drive the price down to consumers, it will knock off a little bit of inflation in the short term. But as soon as you take the subsidy away, the inflation comes back. So, how much longer will you go on doing it, right? And then the other
yeah,
observation, more generally on the gas question, of course, the strategy that was sort of rolled out a few weeks ago included the wacky concept of building terminals to import gas to Australia and I say again, import gas. So one of the biggest providers in the world of gas are now effectively mining it, compressing it, shipping it offshore into the international markets, and our prices are still reflected in these national markets, and then we're actually going to import it back. Again, it shows you how broken this whole model is.
Could well be our own gas. Yeah, it's the gas molecules will sail up the east coast, get frozen, go for a quick ride because Chinese and Japanese companies have all overcontracted, and then sail it back down and bring it back in. It is crazy, but we could spend a whole episode on this. And David, who's a strategist for our funders, I think is more than prepared to come on and bang the table on that one. So
I think we should get David back on again. He was great the other time he was on. Anyway, let's move the conversation beyond the budget, because we could spend a lot of time, in the minutiae, mostly political theatre, very little of materiality when it comes to the markets. But the markets did actually react to the results season, the latest results season, both in Australia and the US and elsewhere. But, what I read from what some of the commentators were saying about the strength of the results didn't seem to gel with what I was looking at in reality. What did you make of it all?
No, absolutely. But, I think I've spoken certainly in the last couple of times I've come on, I was guilty last year of thinking, hey, these downgrades when they come will sort of bring the markets back a bit. But I think by early this year, I'd come to the conclusion that actually no, markets are just going to steamroll through the earnings. They don't really care about them. And that was pretty much what we saw in this reporting season. So I've got a quick chart up. I might... the one on the left this is first quarter earnings. I should pop that a little bit bigger, shouldn't I?
Just go into slide slow mode. That would be good. Yep.
Yes. So the one on the left is what we were expecting 3 months ago. So starting at 100, big tech was going to add 3% to growth, and then you work through all these other countries and ex-US, and you ended up with basically down 1%. The real result was the big tech didn't change, but everything else did, and so we're down sort of over 6% in terms of the world growth. And so you cut out the big techs, and the rest of the world is going to knock you down almost 10%. And so from that perspective, it wasn't a good reporting season. But you roll forward one quarter, and so if you're looking at the second quarter forecast, or if you're looking at the full year forecast, they've barely changed. They're basically, they're maybe down 1%, maybe on what they were. Which basically says you're just factoring in the first quarter and expecting that same growth to bounce back. So, and that's been the case. This has been the case progressively for, 18 months now, maybe longer, where basically we're having bad quarters, and then it's like, oh no, everything will be fine by next quarter, and then that quarter's bad, and then it's always that constant keep looking forward. So, and I do think the market's done it long enough now, and there is some good productivity gains and things like that coming through over the next, I think we've probably got another 12 months, maybe 18 months worth of weaker earnings, and then I do think we will see some positivity. But I think the market's looking beyond current earnings, and so it doesn't really matter if they're weak, I guess is the net effect of what it's saying.
Yeah, and I guess the other interesting observation is it seems to me that markets are now definitely betting on the Fed put at some point if necessary. So if, in other words, if things went a bit off, the Fed would support the markets, right? Which is an interesting observation based on the fact that a few weeks ago, of course, the markets were a bit wobbly because at that stage, the thought was, well, maybe inflation is more sticky, maybe it will take longer, and maybe rates will have to rise. That's the danger, isn't it? Is it what people are most worried about is that the Fed might be hamstrung by and so can't come running to the rescue. That was what I think. Certainly for me, that was what I was hearing from markets is, that the one thing they worry about is that inflation will be so high that the Fed can't come riding in. But as long as it's not that high, then we've sort of got that backstop and that that expectation that they're going to step in and save you if things go wrong. And markets are probably right. They're probably I think in the end
the Fed has come to the rescue lots of times. And I think there's there's some interesting things going on in terms of earnings as well, within some of the sectors some of the tech sectors in particular. I think there's that, obviously that sort of Magnificent Seven, the earnings held up for those by and large, and so I do think that sort of bodes well for that sort of area of the market. And I don't know what the right way to say this, but it seems like the growth is there. We've seen that growth in that part of the market remain really solid compared to other parts of the market, and that's been the one we've got some high valuations on Nvidia and Broadcom and a bunch of other people in this AI sector. I do think we're starting to see some. We're seeing continued spend in that area, and it sort of feels like, well, could you end up with this? Could this be the start of a bubble? In terms of our prices at a bubble level, I'd go, well, they're expensive, but when you start to see those areas sort of show up quite well, and they start to be resilient, and we are starting to get to the end of some of the cycle issues that sort of I had. There's quite a good chart I'll pop up from trying to remember the guy's name who writes this. No, complete mental blank. Sorry, but it's sort of showing the different sectors of the market, and they sort of go through this part where sales increase, and then you get you start making too much, and so then you start getting inventories increase, and you sort of cycle back down, and then the sales start decreasing because you make a bit less, and then eventually you go through that same cycle over and over again, and that part of the market is particularly cyclical. And I think the key thing though, that's sort of interesting for me is, automotive and industrial are still in a bad place from a cycle point of view, but most of the other parts of that sort of semiconductor market are starting to bottom, and it's not just all AI at the moment. I was actually, it looks like this cycle's coming faster than what I thought, and so there's some. I did a podcast on it last week, but I guess the main thing I wanted to highlight is this is an area where things don't last long. I've got a chart up now just showing the Intel and some of the Pentium processors and how long they last before you need a new one. And you sort of got you've only got a 2 or 3 year run at this. And another sort of similar type of chart just showing that this is an area of the market that the what's called the DRAM. So basically memory chips for computers, and just sort of showing that there's just been, over the last sort of 50 odd years, the companies have just come and gone, and it's largely been this really competitive market. But you end up you're only as good as your latest hit, and this technology just keeps churning on, and there's always more spending happening. And so we've sort of got that type of market, starting to improve. And then we've got all this spend from the US is throwing money hand over fist at all these companies to build more factories in the US. Europe's trying to sort of get in on the play. China's being banned from chips, and so they're throwing as much money as they can in this area. There's just, I feel like we're hitting this sort of titanic forces part of this whole market where, could this be the start of a bubble? And it's certainly an area I'm watching, I think, in terms of, could we see this whole AI and chips turn into a mixture of some real strength in terms of the underlying fundamentals, coupled with government subsidies thrown at them, coupled with an interesting story about AI, and maybe we can turn in prices into much higher levels. And so, certainly one to watch for the next sort of 6 or 12 months, I think.
Yeah, interesting. And, there is a broader canvas here, I guess, two perspectives. The first perspective is we know that governments are still issuing a lot of debt around the place. The US is, I think they issued $100 billion over the last week or something into the debt markets, the bond markets. And so that's putting interesting pressure on some of the funding engines, because of course the Federal Reserve and other central banks are actually also going into quantitative tightening rather than quantitative easing. So they're actually not buying a lot of those bonds. So that's what creating some interesting pressures between the bonds and stocks. Within the stocks, we've got some performing quite well, as you say. The AI story is still quite strong, but they're having to run a lot faster and harder to keep up. And of course, they're the AI. It's a yin and a yang, right? So you've got likes of Nvidia who are actually creating the chips, and then you've got other larger, big organizations who are taking those chips and trying to actually doing something with them. But they're buying from each other, so they're actually a bit of a circularity, right?
Absolutely. Actually, sorry, you could go.
And none of them, the point I was going to make, none of them need funding.
Right? No, exactly. That was my
disconnected from the bond story.
Yeah, and that's where the bubble part comes as well, is because most of the time when you get to these bubbles, you get this big debt increases and they all start trying to buy each other, or they all start trying to, gear up to. It all becomes about, whatever it is, eyeballs or seats or whatever you're trying to do. You'll borrow money because the market's going to pay you all this money, or going to pay you this huge equity multiple, and these guys have all got truckloads of cash, and so. And that's what I'm saying about turning into a bubble. There's so much room for them to start turning that cash into debt and spending more money that, that it feels like some things are going on. And I guess I probably should have put it a little bit better. I guess the overall theme that I sort of wanted to say there is that let's sweep NVIDIA aside, because most of its money is AI, but a lot of these other companies, Broadcoms and other ones. Yeah, they're involved, but it's quite a small part, growing really quickly, but it's a small part. And so what I'm saying is, if you take a company that's got 10% AI and that's doubling every year, and the rest of the business is basically going nowhere, then the whole company is growing at 10%. And you can argue that it's an AI company because it's got this and it's growing really fast, and I've got a certain multiple. But when the rest of that company is actually growing at 5 or 10% because it's bottomed and now it's starting to take off, and so the company itself is now starting to, give you 20 and 30% growth rates as you start going forward, because it's got the large part growing all right, and then the small part growing at dramatic levels. That's where these bubbles start to come, and people start to convince themselves that, the whole company is going to, you get the NVIDIA story effectively. I mean, that's where, and so, so I guess I'm certainly paying more attention now because I was sort of looking at these companies 6 months ago and 12 months ago. Yeah, okay, all this 90% of it's all pretty weak and poor, but the 10% is going well, and now they're starting to look going well. Actually, now that whole train the cycle's moved a lot faster, and the amount of money being thrown at these guys by governments everywhere. It's you can get them going into more debt. Governments throwing money, things looking all right. Fundamentally, it just seems to have all the recipes lined up for something that could drive markets much higher. So not saying it's going to happen, but it's certainly, if I was looking for one area, I'm much more convinced that this could be the area than I was 6 months ago. Yeah.
And plus, of course, people like Google are now actually issuing dividends, and they're buying share buybacks and all those things happening in some of these big tech sectors too. So they're doing quite a lot to lift their prices even higher as well.
Yeah, and so actually, I didn't put up that chart. There's another chart I did have that's well worth thinking about. So overall, the IT sector. So you can break up the market in lots of different ways, but the most common way is what's called a global industry classification, or GICS. And so when you do that, there's 11 sort of major parts of it, and the biggest part is the IT sector, which is the smallest part in Australia. And then the equal biggest part of the IT sector is what's called the semiconductors, which is those, these charts I was talking about, and the NVIDIAs and these guys. And Australia doesn't have any of them. Well, Altium vaguely, but they're certainly involved in that. But they're more of it. They get classified as software. But so I guess what I'm saying is, effectively, the largest part of the largest sector in the world, you just can't get in Australia. And so it's one more reason to say, well, if you want to be looking offshore, and if this is this next place where, if there is potential for growth here and all this money being thrown at it, is saying, well, don't throw your money at the ASX if you're expecting this to happen. If you're just looking at it saying, I want to make sure that if there is a big bubble that I've got some exposure and I'm not going to sort of underperform that basis, you've basically got one software manufacturer in Australia, and that's about it. Yeah.
Right. Well, let's just sort of briefly reflect on the differences between the ASX and the US, because the tech sector in the US is huge, growing, big investment from government in the US, specifically into some of those migratory stories into the green economy, all of those things, right? Come back to Australia, we've got obviously a lot of resources. A lot of those resources are now trying to work out what to do as sort of demand supply disequilibrium starts to appear in some, steel prices are somewhat down. We've got limited government. There is, the government's talking about its manufacturing in Australia, but the quantum that they're talking about investing is so small as to be relatively insignificant.
It's dwarfed by their own marketing budget for it.
Spot on. Yeah. We've got a significant proportion of our economy that's still in the sort of the financial services and banking sector. But interestingly, that the recent results in Australia showed that some of the bad debts were starting to trip up. They, not dramatically so, but higher than previously. And then we have things like, the Perpetual, where effectively the wealth management business that they were sort of betting on sort of didn't really work. So you got to say that the whole ASX looks a lot more wobbly, despite the fact that the ASX has now hit significant highs again. So,
we're certainly not in the sectors. Not in the sectors you'd expect it to grow as that part. Dependent largely on China and the housing market is the only thing I'd say. Is that we've obviously got a huge bet on resources. And there's been a lot on copper. Actually, I think I've got a copper chart. I should. It's interesting when you look at how much the traders are betting on copper at the moment. This is a chart just showing the non-commercial net sort of holdings of players, and so it's rocketed in the past month or two from sort of negative where traders are betting that copper's going down to now sort of massively high. Now, the issue with this is, and we've got BHP making a bid for Anglo, and so there's this whole thing about can Australia, and Australia's a huge player in lithium, and Australia's got some copper resources, got a lot of copper resources. Maybe it can be a big player in that, but when you look at those sectors, they're just so small as a proportion of the overall Australian economy and of the world. So coal makes a massive difference. Iron ore makes a massive difference in Australia. Everything else is an also ran. The lithium sector could double in Australia and still not make much of a difference at all to the overall outlook. And not only can double, it will double over the next few years. But it's just not that big in terms of the whole scheme of things. And more and more with those metals, it is about the processing. So, I mean, iron ore and steel. Steel is certainly a big issue for iron in terms of processing. That is a large part, but it's still a relatively there's not a lot of technicality to it. I start with iron ore and I add some things to it and I end up with steel, and it's the process is pretty well known. It's been around for hundreds or thousands of years, and so it's not like you can be technologically advanced with it. Whereas you go to something like lithium and you're like, well, the way they're putting batteries together is changing in whether you get sort of semi-solid and solid batteries, and there's a lot that sort of goes into that. Or you look at solar panels and the ingredients into those and how it's being put together and the different things like that. It's about that processing and about adding that extra intellectual property to it. The original cost of the minerals you're putting into it is important, but it's dwarfed by the technology that sort of produces the outcome. And so, if Australia is going to be could be a huge exporter of all these commodities, and we could be great at digging it out of the ground really efficiently, and all that type of stuff, but there's just not that much value in that part of the market.
Absolutely. And I guess the story of copper is quite interesting. I don't know whether you saw, but there was a particular one on Twitter showing that people were nicking the copper out of the recharging stations, right? So they go around and pull all the copper out all the way down. I think they were Tesla recharging stations in the US. So that's another interesting little twist there as to how the copper story is playing out. Other interesting question though is consumer sentiment looks pretty weak, right? Both in Australia, US, the Michigan data that came out last week was quite low. Sentiment here in Australia. And that's reflecting into the retail sector. So the results from the retail, both in the US and in Australia, were actually somewhat down on what people had expected. And I think there is a strong...
And more so I'd say Australia is particularly weak.
Yeah, exactly. So I guess the question is, what's the thinking there? I mean, the fact is that people are under pressure. And, Cookie Boy sort of put it like this, which was, what's the solution to the struggling retail sector? Wasn't mass migration meant to help, right? Because
but I'm sure it is helping. I guess the thing is
yes.
I'm sure
it
mass
would have been worse without
it. Exactly, yeah. But it's this question about saying, look, can we be in a per capita recession? How long can we be in a per capita recession for the rest of Australia? Yeah. And so that's one part. The other part is very much coming back to what you're talking about, saying that the private sector data that we're looking at, and the survey data and all these other sort of the soft stuff that sort of goes into this, looks way worse than what we're seeing out of the ABS, and particularly on unemployment. And so the question really comes down to saying, okay, so is this, and there's been a number of different other central banks have been talking about saying, well, maybe our measurement's wrong. There's actually a few things that have changed in terms of how this has been, and a whole raft of different reasons as to why. And so we've seen the US Fed consider it. We've seen the Bank of England consider it. I think the number of sort of quite well thought of Wall Street journals and Financial Times have sort of been running these articles on it. And I guess what I wanted to overlay, all these thoughts they're having around maybe we're not measuring unemployment properly, is that within Australia, we're running, and Canada as well for that matter, running such high levels of immigration relative to what they used to run, is that makes the numbers even worse insofar as there's a group of people, I think it's something like 8 groups or something like that, and sort of every period you just sort of drop one group and you add another one to it, and you're trying to track those people over time. Is that if you're bringing lots of extra people in, then the people you're bringing in aren't in those groups because those groups you sort of set up beforehand. And so you're missing that group of people that's coming in. And if they're underemployed and they're having problems finding jobs, then that's not being captured in your official sort of ABS stats. But they do seem to be popping up in lots of other ones. And I think that's that question about we've got all these things that are saying they're looking quite weak. You've got things like retail sales looking quite weak, and really, I've got a chart up sort of showing some of the wage numbers look like they've sort of come back into more normal ranges as well. And so, when you've got all these things all pointing in the one direction, but unemployment holding up and looking all right, I guess you have to sort of question, well, maybe we're measuring the unemployment wrong. Maybe that's the problem. And so, and if that's the case, then maybe things are a bit worse than what they look. Yeah, and then look, company profits says the same thing. I mean, as I said, we're down. They're 6% lower than what they thought, and I still feel as if I spoke about this on the last couple of times I was on. I'm sure I still feel like there's definitely this disconnect for when you're listening to companies talk and they're talking about how this quarter wasn't that good, but we're expecting to push through these price rises and we're expecting all our cost pressures are all going away, but we'll still be able to keep raising our prices and that'll widen our profits. And when you listen to one company, it sounds reasonable, but when you listen to dozens of companies tell you the same story, you start to go, well, just a minute, your costs are somebody else's revenues. And so if you're telling me that, cost pressures have gone away and I no longer have to worry about rising costs, but I'm going to keep raising my prices, you're effectively saying, yeah, everyone else is going to cop it, but not me. And it is definitely true for some companies, but it can't be true for everyone. And that's effectively why I think we've seen such weak earnings for the last 3 or 4 quarters at least. But it's still, the expectation is it'll turn around, but It's I think we're some time away from that. I think 12 to maybe not 12. Yeah, at least 6 months, could be 18 months, 6 to 18 months away from actually seeing a genuine bottoming in profits based on the cycles.
Yeah, and but going back to are we measuring the employment and unemployment numbers correctly? Of course, it's a problem, as you say, not only in Australia but elsewhere. Many countries with big migration. But I had to take, in my surveys, I take the ABS census data as the baseline, but I've had to actually significantly change that baseline now to allow for the fact that we've had such strong migration into some areas, so it's not uniformly spread, right? And what that actually means is I was modeling scenarios in terms of what might happen to house prices, and without the migration element sort of physically updated, almost real time, because you have to keep up with it, the scenarios are more negative than we turned out to be. But once you'd actually got the inflation thought about and the inflation of the migration statistics plugged in, that lifted the total demand, and that actually then moved house price scenarios back up to where they are, which is growing mostly other than in Victoria. So I do think there is a really big question as to how the official statistics are actually catching up or not with what's really going on. And that's a big deal, right? Because if the compass is broken, it means that even the RBA, when it's trying to make decisions and they're wanting to be, quote, data dependent, they could actually be perhaps data dependent on the wrong data.
Exactly. And we spoke about, just the pre-show, we had a quick chat about the whole inflation numbers and about how, the budget forecast we're talking about, it's a few years ago, probably a year ago or 2 years ago, they were talking about, okay, we're going to try and bring in sort of, 250 or 300,000 people is roughly the thing. And then they came in with 700,000 is just that thing that, okay, it sounds like something the government has control over, but they don't. It's not and the things they've been doing in terms of, I guess, educational swaps and everything with India and some new ones coming out, that says, well, that sort of puts more upward pressure on it. And so if they got it wrong by hundreds of thousands of people on the way up, and now they're saying, oh no, we're going to bring it back to sort of the 230,000 or whatever. I think there was a number in this budget. I think I saw maybe 235. Is it, well? Will they? I mean, they said 280 and they came in with 700. Now, if they're saying 235, does that just mean they'll come in with 500? Like, is it, is there a, I'm not saying this is something that should be easy to forecast, but generally speaking, in government policy, you're going to do too much. You're either going to do too much or too little. And it's obvious we did way too much in terms of bringing people in over the last couple of years, well, way more than what they're expecting. Let's put it that way. Now, to me, it doesn't feel as if we've had much change in policy that's going to push it. I don't think they've over tightened. I don't think they're going to go, oh, we thought it was going to be 230 and it only came in at 100, because we got the settings way too tight. It looks to me as if the settings are still probably going to err on the side of being too loose. And so, my guess would be, based on everything we've seen so far, if we're wrong on the numbers, it's going to be higher than 230, and it could be double without too much of an issue.
Now, if you look at last year's, I haven't seen the latest numbers. I haven't looked at the budget papers yet. But last year, they had a bit of a rise, and then back to 260, 260,000, right? So for 4 years, right? Now, they hit a much bigger number, 600, 700, depending on how you measure it and when you measure it.
Yeah.
The student element of that was quite significant, although there were other classes of migrants that were also coming in quite strong as well. Now, they have said that they want to put more emphasis on the universities providing accommodation for these students rather than putting them out in the rental market, which sounds inferior, Australia, but you wonder about that. But the other interesting observation is that, of course, the mix now of students coming in from overseas has changed. So there were a big wad from China that's still there, a little bit down, but now we've got more from India and we've got more from Vietnam, et cetera. But those are tending to work in Australia to be able to pay for their passage in education rather than pulling money in from overseas. So there's a bigger philosophical question as to how can you claim this as an export when in fact now it's being paid for by activity in Australia. So not only are the numbers wrong, but the whole philosophy of the way that the budget is built from a reporting perspective and from a GDP perspective is wrong as well.
Yeah, exactly. If somebody comes here and earns whatever $30,000 a year to working in various part-time jobs, and pays 50, and that's treated as a $50,000 export, as opposed to saying, well, the net effect is, so that's definitely an issue. And as you said, in terms of keeping wage growth low, I mean that's one of the hugest things for me in terms of keeping wage growth, and why I think in Australia we haven't seen anywhere near the wage growth that you saw in the US. The wage growth in Australia was pretty muted in the end. And while companies always talk about wage pressure problems or whatever, there's no what do we hit 4%? So and most of the time that was negative anyway. It was negative real wages anyway. So I think there's we're locking ourselves in for the same. More of the same, I guess, is what I'm doing, and weaker growth in Australia on that basis. I think if you can, where am I looking for? I'm looking for the exposure to some of the ones that do benefit from that whole, we pull more people in and make everything tougher for everyone, and so be people like your Transurbans and stuff like that, where they're basically benefiting from this push towards more population, but. I'm much keener to get my money offshore at the moment. We're sort of more probably 2 to 1 or better in terms of buying international assets rather than Aussie assets, with a view that I still think there's much more interesting sectors I can get in a hold of that I think are going to do better over the in the coming years, and certainly they've done better over the last year. Even over the last year, you've done a lot better, and then avoiding some of the that real concentration you can get in the Aussie market as well, is getting exposure to a more diverse set of sectors.
And plus, of course, the exchange rate, the Aussie is relatively weak to the US, so that actually can be positive when it comes to US earnings.
Yes, yeah, absolutely. And so just to put it in perspective as well, there's a lot of textbook stuff you read about, and a lot is written from the US looking out as saying international equities are more risky than domestic equities, because often what happens is when the US booms and the currencies work in opposite directions, and so you can find and so investing into Australia is a great example. Is that when the world economy is booming, the Aussie dollar goes up, and so if you're an US investor investing in Australia, the stocks go up by 15%, but the Aussie dollar goes up by another 10, and so you've got a 25% return. But the problem is when economy is weak, and the reverse happens, is that stocks then go down by 10%, and the Aussie dollar falls by another 10, and the next thing you're down 20. But as an Aussie investor looking out, that actually works in your favor, because the currency works at cross purposes. So when the world's booming, my foreign stocks might be up, I think, 30 or 40% over the last year, but the Aussie dollar, offsets some of that. And then, when we see, we hit the pandemics or financial crises and things like that, and yes, stocks all tumble, but so does the currency, and so it gives us that nice offset to reduce your risk a little bit.
So let's just sort of think this through slightly, because one of the things that I mentioned earlier on with the high bond yields, bond yields are quite a lot. Now they've come back a little bit. So, the 2-year in the US touched 5 briefly. It's come back. But the funding costs for many financial entities are actually quite a lot higher than they were. We've got negative balance sheets amongst many central banks who bought bonds at one point and are now need to hold them to maturity. Otherwise, they're going to have to take a hit. And we've had a series of small bank failures or medium-sized bank failures in the US, for example, where the bank's been effectively bought out and recapitalized and rescued. And in fact, earlier on, there was a bit of a question that came up: do banks have bank funding programs for liquidity support for failing banks? The answer is yes. They have a system whereby the bank can be effectively reconstituted and taken over, and that's happened a few times in the US, and will happen probably some more. So one of the real questions then is, what's your reading on the financial sector? Because the results from the financials were, relatively okay, but I think of Macquarie, Macquarie's profitability was down quite significantly because some sectors were doing quite well, others weren't. And it's true also if you look at the results in many other financial sector organizations around the world too. So it's not as simple as, well, when interest rates go up, they make more money. It's much more complicated than that. And with the high cost of funding, is that going to cramp the financial sector, do you think?
Yeah, look, I guess the first thing I want to say is it doesn't concern me from a macro perspective. It doesn't concern me as much when I see banks falling over because of they've got their hedging wrong, or they've done something with bonds that they shouldn't have. They've bought too much bonds and expecting it to go the wrong way, and they run out of money. That's to me that's they're idiosyncratic issues within smaller companies, and or maybe it's not even idiosyncratic. It's not threatening to the financial system as a whole, because it is really a question about timing and can you hold out when you start to see bad debts rise. That's the key. If these companies have been doing the bad debt lending, and so I guess the things I would say, certainly over the last, so Silicon Valley Bank, and that was about a year and a bit ago now. I think I was probably a bit more concerned that we would start to see the commercial sector start to come up with problems, particularly in the US, the US commercial banking sector. I think as time has gone on, that those fears were shown not to be completely unfounded, but certainly they're being extended. All those loans are being extended as long as they can, and a lot of those companies have got certainly corporate sector has got some really long lending, so they've all locked in rates at much lower levels. And yes, their interest rates are increasing, but they're whatever it is, 5% of their bonds are expiring this year, and so and those might be jumping from a 1 or 2% rate up to a 6 or a 7% rate, but it's only 5% of their overall borrowing. And so it's just that it's ratcheting up, but it doesn't seem to be causing acute problems. Now, could there be acute problems? Yeah, maybe. But certainly from what I'm seeing at the moment, it seems as if the banks are putting away. They're using their moment in the sunshine to put some more money away to prepare. I guess I'm less concerned than I was 6 or 12 months ago. And I do think while there's risks there, this whole extend and pretend and sort of get through this next little while, US government throwing lots of money. So most other governments running these massive deficits, corporates are benefiting from it. The loans are only gradually gradually falling due. I don't know. I guess I come back to that. It doesn't seem. I can see the problems, but I can see where we might just get out of it with a relatively light. Profits fall for 18 months or 2 years. The market keeps looking forward, so it doesn't really care. And then by the time profits start rising, okay, now we're already through it, and we're on to the next big thing.
And it's worth remembering, of course, in the US, the Federal Reserve did put a backstop into the banking system as well, and allow people to be able to actually deal with those bond values, not at the current market value.
Yeah, sorry, that's right. That was one other thing I meant to say, is that you have the Fed, you have all the central banks now. That if you think about them as firemen looking for fires, it used to be that they'd sort of sit and watch. They'd watch the thing start to burn a little while and go, well, is it going to go out by itself? Will we, can we just sort of wait for a little bit, see if this does get any worse, and if it so, then we'll flood it. Whereas now it seems as if the first sign of trouble, there's like, bam, liquidity hose, pump, throw that straight at whatever the problem was. So then, and that was that whole Silicon Valley Bank sort of episode as well. It sort of, I guess, it gives that market the view that, look, the Fed's got their back, or the Fed's certainly, they're going to keep. If you took the stability breeds instability sort of argument, they're gonna make things as stable as possible until they get so unstable. And actually, maybe I should explain that for the viewers. That's the idea is that that when things are really steady and really there's not a lot of volatility, is that what do human beings do? Well, that means I need more leverage. And if you get more, if you're used to going through wild swings every 5 years, you're having depressions and recessions and everything like that, you don't want to carry much debt. But they managed to extend that between a 5 to 10 year out to a 20-year period before it. Now I go through 10 years of like, wow, things are pretty good. I haven't had any problems. I've got to throw more debt and I'm going to build this, and you just build up these massive amounts of debt until it gets so big that then eventually it has to fall over. And so the idea is that humans will use stability just to create more leverage because that's a great way of making money, until the whole thing blows up. And so, and that's the argument as well. If the Fed keeps on running around and putting out fires before they start, and a bit like your bushfire, eventually you get so much dead undergrowth sort of build up that when the fire does come through, it's a massive fire and it gets so big that you can't wipe it out. So, but if that's the case, it doesn't feel like we're that close to it overwhelming us. So we're probably you've got a decent sized run before it gets so big and get so much instability.
So the commercial real estate, of course, is probably where the fires will be the most severe, other than the bonds. The bond stuff was bad hedging in the case of several of the medium-sized banks. But if you look at the proportion of banks in the US, the mid-sized ones that have issues, it's about 500 of them sitting there with issues, but not necessarily raging fires. But they are more and more leveraged. And, Jason made the point, I'll just put this up again because I thought it was a really good point. The bigger banks just buy out the failed ones. Perhaps, they're big enough to hide it. So maybe that's the way to think about it.
Yeah.
It hasn't gone away. It's just gone somewhere else.
Yeah, that's right. And that's, that's an age-old trick that banks, that central banks do. And it's effectively what China's been trying to do with some of their with some of their property developers. Is a similar type of story, but that's where you start to run into problems that the one or two good ones I had left are now terrible because we keep making them buy the other ones, and so and that's the danger. It's that part with the banks is if it's a small problem, fine, you can you've got a big solid bank and you put a smaller bank with problems in there and it's 10% of the portfolio. Yeah, we can weather that. The problem's once it starts spiraling, gets too far, then you can't do that anymore because all you're doing is saying, I'm going to take my good swimmer and drag it down with my bad swimmer. Absolutely.
And interestingly, of course, Macron came out overnight and said that his view was that because of the global instability that now exists and the fact that various economies were sort of fragmenting, he thinks that there's an opportunity and a need for some of the banks in Europe to get together and effectively become larger because they can't rely on some of the international pillars that were there previously. So he was advocating, even bigger bank in Europe.
Oh, really? Yeah.
I was just thinking,
that's right.
Credit Suisse, it's okay.
Yeah.
Is bigger better?
Yeah, exactly. And that all I hear on that is that, well, from a banking perspective, that some of the banks executives are basically, we need to make ourselves big enough that the government has to bail us out if something goes wrong.
Too big to
Whereas
fail.
if you're a small one, you could lose your job, anything could happen. Whereas if you're a big one, okay, something goes wrong, I stuff this up, they'll have to get this. So no, that's I'm a big fan of charging big banks that's a too big to fail fee, so to speak, in terms of saying, let's try and level the playing field. I'd much prefer to have lots of smaller banks, that any one of them can fall over or make a problem or whatever without causing the whole system to have problems. But I think
the German banking system is a good example of that, where they've still got very, very large numbers of relatively small banks that are actually quite effective community banks, effectively, relative to some other European markets or indeed global markets, whereas you get bigger and bigger. And then, as you say, there's an implicit support from government, like in Australia, the Big Four and probably a few others. The international investors assume that the government will always bail them out.
Yeah, exactly. And they have to. And so that, I guess that's the thought, is Australian banks earn some of the highest returns in the world. So some of the most profitable banks anywhere. And part of the reason why is because they're close to the regulators, and the regulators effectively said, yes, we'll let you. You've got this implicit guarantee, so you get to borrow cheaper than other banks, and so the other banks in Australia that don't have that implicit guarantee, and so you're more profitable. Whereas, arguably, you should be charging them for it, and and that's making a more level playing field and running less risk in your economy.
As Jason says, once they get into the too big to fail group, then the government has to step in and actually incentivize greedy behavior to make them bigger, which is not necessarily right for ordinary people. I think that's a very relevant point.
Yep, and it's worth saying as well. I probably say it most of the time here. How many years ago was it we had a banking royal commission, and we decided all this stuff was no good, and we had to. And none of it's been none of the important stuff has changed, and we're still in the same position.
Behaviors still very much the same. Now, there's another interesting and important conversation to have, because Janet Yellen's been talking about tariffs. And, it sounds as though the Biden administration is likely to extend its tariffs from EVs, particularly thinking of China, but not only China necessarily, but to other categories too. And this is, again, another of the examples of the breakdown of the old trade order that we had. What's your perspective on tariffs, firstly? And secondly, can you sort of factor some of this into the investment decisions you take, or is it over the horizon? How do you think about it?
Look, it does affect it does affect investment decisions, particularly in terms of I haven't got any car investments at the moment. I've got relatively major concerns for a lot of the car companies. So it's probably slightly unrelated, but it does make a difference in terms of say there's some of the industrial policies. And so industrial policies can range from a whole bunch of things. There's carrots and there's sticks, and there's an argument that what China is effectively doing is they've funded all these car companies and heavily incentivized them, and a lot of them are running at big losses. There's some quite fascinating pictures. I haven't got any on this slide. I'll show it sometimes on some other ones of all these cars that have got all these grass and trees growing over them because they're basically just being parked, and all these EV companies that went bust because that's what they're all this funding that came into that market. And so in those policies, to me, it's certainly fair if one country's decided it's going to subsidize its companies in a certain way for other countries to say, well, that's not fair to their own manufacturers. So we'll put in sort of countervailing, or whether it's a tariff, whether it's an explicit tariff, or whether it's just the some rules, some environmental rules that basically mean that it sweeps out those companies and but keeps in US companies. So a lot of that will lead to higher prices within the US. It's interesting that the electric vehicles are actually a pretty small part of the US market to start with. But it probably does mean, overall they're going to be paying higher prices for cars in the US. It's actually Europe's looking at putting on tariffs, but it's sort of interesting as well insofar as Europe still exports more cars to China than what China exports to Europe. So they want to put on all these tariffs to protect themselves, but in a way, it's like, well, if you're sending us 10 million cars a year and we're sending you 10 million cars a year, then what are you complaining about? The more interesting one for me is what's Australia going to do? We don't have a car sector to protect. So are we going to just take cheap cars from everyone that wants to subsidize themselves? Or are we worried about actually the amount of sensors and stuff like that that's on a lot of the sort of modern cars and what that might be doing? So I've got no idea what Australia's going to do. I think the moves so far seem to be lowering tariffs for Australia, but net effect from a company perspective, I certainly don't look at companies protected by tariffs and think that there's going to be this great windfall for them, because it tends not to be. So you look at all the tariffs the US put on Chinese exports during the Trump administration and increased with the Biden, is that what that tended to mean was often that it just meant the production was done in other countries like maybe Mexico and Vietnam and things like that. The actual car companies within the US, or the actual companies sort of protected, didn't benefit so greatly that you sort of I think there's some help to it, but I don't think there was so much help that you'd suddenly say it's worth buying those companies over everyone else. It sends, I guess, the benefits tend to be spread wide, I guess, is where I'm getting to.
But tariffs, of course, can be inflationary because it puts prices up.
Yes, higher inflation is
the home
definitely
economy.
the case.
Yeah.
Yeah, that's right. But having said that as well, goods inflation isn't where the problem is. So we've got deflation in goods. So I sort of look at that and go, well, okay, yeah. So overall, the overall inflation rate will probably be a little bit higher, say. But where the danger is really in services. That's where you can get that. That's where the sticky inflation, if it comes, will sort of show up. And so, seeing more tariffs on goods to me, it just sort of means that they'll be slightly higher. And I do think there's still a big overcapacity problem in China. And so, does this mean China exports more to Europe? Europe exports more to the US, and it's probably the world's a big place, and a lot of these just shift around, so that the benefits and the costs sort of get spread a little bit more widely. So my take would be. Is that and look, Trump's obviously got lots more tariffs. I think he's calling himself tariff man or something like that. He's got lots more tariffs that are going to go on that. I think that just means higher inflation for the US, but I don't think it's not structurally higher. I guess to me and the US and China has lots of spare capacity still. They've been throwing money at these issues.
Yeah.
And actually, what's interesting as well. Sorry, well, actually, that's another point I was worth making is the amount that US has been throwing out in terms of chips and a lot of this onshoring to bring down its factories. There is a capex boom going on, a genuine capex boom within the US, and China's got a countervailing capex trend where they're throwing lots of money at these issues as well. And Europe's trying to do what it can. It's a fair bit behind, but it's certainly not. It's in some way involved. These are the types of ones that are actually quite good in terms of inflation. When you've got a consumption boom sort of driving inflation, then like we did during the pandemic, that's where inflation can get out of control and shoot up. When you've got countries fighting with each other to spend more money on capex and build over capacity, that usually means lower inflation. Once you sort of pass through that initial phase of all this demand for people to get out there and build these things, that's sort of got a little bit of an upfront cost, but the longer term benefit is flows through in terms of more productivity, whereas consumption boom doesn't give you that same sort of longer term benefit.
Absolutely, and of course. As some people are saying, I think Cookie made the point a little while ago, tit for tat, right? So, you get tariffs in one place and then basically somebody else ups the ante there, and then you're sort of chasing each other around the place. And it gets more and more complicated. And as you say, goods inflation, not too much of a problem, although actually it's a little bit of a wobble in some areas now. So it's one to watch. Yeah,
and the other thing just to note as well is that a subsidy of a company is effectively it's not dissimilar to a tariff anyway for other countries. So whether I'm paying whether I'm giving them all these tax breaks and all these things, so companies in my country can produce cheaper than everyone else and put competitors out of business in other countries is not that different to then saying, well, why don't I just increase the cost of other countries? And so and I think it's so. I think tariffs people think of tariffs as being more important because I think during that was the more visible thing I think we saw in the Thatcher and Reagan years and Keating years of lowering tariffs, but industrial policy has lots of different ways to sort of basically advantage companies in my country over companies in other countries, and I wouldn't ignore the other forms.
Absolutely. Well, there's two other things I want to touch on tonight. I want to touch on gold, but before I get to gold, I just want to touch on something else. Chris Joy has written a couple of articles recently saying central banks around the world have become more and more, or risk becoming more and more politicized. And in fact, there was an IMF report that said, given the number of elections that are running on around the world at the moment and the aspiration to drive interest rates lower ahead of elections, how independent are central banks? Now, it's interesting that Powell, in the press conference a couple of weeks ago, was asked specifically about, do you take any of the political stuff into account? And he said, no, absolutely not. No, and he was almost a bit annoyed about being asked that question. But this sort of idea that central banks and central bankers are, somewhat directly or indirectly affected and influenced by the political ambience, whatever that might be, is, I think, quite an important question. And I guess I've some skepticism personally about how effective central banks are. But what's your take on this debate? Is it a non-event, or is it something that, again, is something to think about? And do you have to take it into account when you then think about your investment strategies?
Yeah. Look, I'm just trying to think how much time we've got here, Mark. No, you had to ask me at the start of this. We could have kept on going. Look, I guess I've got this issue about. I do have a problem with independent central banks. I mean, I get the idea, and I buy the fact that, you know what? Sometimes you do want to have other people, not politicians, sort of driving this in terms of they'll be more independent than politicians, and they'll try and pick it to the right level of the economy, not just to get votes and et cetera, et cetera. But the flip side is you run into situations, and I think Australia has certainly seen this a few times, where you have a central bank, so pre-COVID, a central bank madly trying to get growth out there, and a government hell-bent on achieving surpluses, and so working at cross purposes to each other. And so I do sort of, in a way, if you're giving it all to a government and saying, right, this is your job, I don't care if you want to use monetary policy, I don't want to care if you use fiscal policy, they're all tools you can use, pick the best one and use it. But you're in charge of this economy, and it's your fault if things go wrong. Whereas I feel as if, to a certain extent, central banks mean that governments can go, well, yeah, okay, I was trying to produce surpluses while the central bank was madly trying to get demand up there. So I was sucking demand out of the economy while they were trying to do it. But it's their fault that growth's been so weak because they're an independent central bank. That's their job to do growth. And so I sort of feel as if it's a little bit of trying to outsource the blame for who's when things go wrong. Is it their fault, or is it government's fault for what they're doing? And governments have been very successful at pointing and saying this is all central banks now. None of it's our fault. Whereas I do think governments have got just as much say, and it's not just you've got fiscal policy, monetary policy, but then you've got the industrial policies and all the other what's going on and everything else that's incentivizing or increasing equality or decreasing the inequality that sort of make a difference to economic growth. So yeah, look, yeah, it's a problem that they're more I'd like to see, if you're going to have an independent central bank, then make it properly independent as opposed to like a pseudo independent. But it is difficult to when most of these guys are all appointed by governments anyway and paid for by governments. I mean, we saw in Australia, a lot of debate over that and how much are they getting paid and whose problem is it, and are they going to get reappointed or not? And that same thing goes on in the US. And yeah, that's in the back of people's minds. But I think, I don't know. I think the net effect is it's the overall policy you should be looking at as an investor, not just what the central bank's doing. You do need to take into account other stuff from the government, and so central banks can get it wrong. They can be completely independent and get it wrong, or they can be dependent and get it wrong anyway. So who cares what the motivation for getting it wrong is? The
shorthand of that is central banks often get it wrong. Period.
Yeah, that's right. But that's what I'm saying. Like, so who cares what the motivation? If it's noble motivation or not, is just that's the hand you dealt as an investor. You got to deal with that. And so, I don't know. I'm probably less sensitive to that issue than Chris.
Yeah, well, it's interesting because he's really been pushing it quite hard over the last little while, and I think of Warren Hogan, who actually said that some of the government interventions through the budget are more like sort of political tricks rather than anything else. So there's a lot of people throwing a lot of mud in a lot of directions at the moment, which might tell you a lot.
Yeah, but I do think as well, like incentives matter, and that's why I'm saying industrial policy and things like that. Like there's some of these. It's the part where whatever you've changed your tax rates, and now all of a sudden for a mother going back to work, she's running an effective tax rate of 60 or 70% because they lose benefits and pick up taxes, and there's things like that just mean okay, well less people work, and so maybe that brings unemployment rate down in a traditional sense, in that there's fewer people looking for work, for jobs, and all that type of stuff like that. But it's worse for the economy because there's people that could be working that don't work, and so I think there's those types of things that that we see in budgets and we see in fiscal policy that are very important to that longer term growth rate, and that's what you really want. Like in an economy, if I can see this. The signal versus the noise is that some of the monetary policy decisions are noise around that signal, and so we've overdone it on one side and overdone it on the other. But if we've got an economy where in real terms we're going backwards, and on per capita terms we're going backwards as we have in Australia for the last little while, then maybe the guys doing interest rates could have been tighter or looser or whatever. But it's the policy settings that are getting us going backwards. That's the issue. That's the trend we need to reverse. The short-term fluctuation about are we growing too slow or too fast is more academic to me as an overall. Yeah, it makes a big difference in the short term to markets, but you want to be, for me, you want to be investing in stock markets because you think there's this long-term growth rate that I can take advantage of, and the signal, and do I get in and out with those ones? You might lean in and lean out, that like we try and do with our portfolios, but it's about having that core exposure and getting that growth in the longer term.
And one of the things I want to pick up there is that we've seen significant volatility, in stock markets and other things in recent times. And of course, there are significant volumes of traders, some of those driven by algos and some driven by just making calls, who actually like the volatility and try to trade profit. I just want to highlight that, to my mind, that's a very different philosophy to what you're talking about, which is the longer term investment strategy that is laying the plans out for a longer period of time. But I do think often in the stuff written and some of the online, particularly, and in some of the other media, the two things get very scrambled.
Yeah, absolutely. And I've got, that's probably one of the things we often struggle with internally. It's a tough decision to make when you're sort of going, look, I like the outlook, but I like the overall outlook. There's this sort of upward trend to it, and that's where we're headed. But actually, things are looking quite bad over the next 6 months, and they're the ones where you're like, well, so do I stay invested and run the risk that I miss this upward trend I'm going, or do I go with the short term and vice versa on the upside, where markets are on this big swing? So just before Christmas, we sort of went, look, we're actually a little bit negative, but actually we're going to just buy stocks because they're on this run and we can see where the growth rate, we can't see the catalyst for it. And so they're the toughest decisions to make. The other ones are easier to make in terms of when you want to move in the same direction as what your expectations are. But the main thing, there's two parts to that for people who are doing this at home. Is one is keeping an eye on that overall part. Is you might not, if your goal is to have, say, 80% equity exposure over the longer term, is that things might be getting bad and looking worse, and you sort of feel this urge, I've got to keep selling, whereas you're like, well, no, I need to keep an eye on that. Where's that long-term part? And I don't want to be too far under or too far over at any one point. And the second, the trading side of it can sorry, I think my microphone's gone a bit weird here. The trading side of it can really cost you from a tax perspective. So if you're in and out all the time, a 20% return if you're just buying and holding, is a 20% return. You haven't had to realize those capital gains along the way. But if you got a 20% return and you've bought and sold 4 times to get there, is that you might only have 10% because you're paying 50% tax or whatever all the way along. And so, every time you're making that profit. And so, it can be how you're doing is important for people that are looking for this longer term wealth. If you're looking for an entertainment and an alternative playing the pokies or heading to the casino, then the stock market's probably not too bad. The odds are in your favor, whereas at the casino they're against you. But do keep in mind, building that longer term wealth, you do need to sort of set up your structures so that you're not paying for it in tax the whole way.
Yes, the tax stuff is pretty significant, and of course now we've got the unrealized gains question coming into vogue with the in the superannuation sector, more than 3 mil. They're going to start nicking that.
No,
right?
that's yeah. Look, look, in the end, for me, it's an interesting one. That I get the whole. I don't like when they try to put taxes on unrealized capital gains. I'm with that, but on the flip side, superannuation. This is the money that we're giving these massive tax benefits to people. So if you've got $3 million in superannuation, you know what, you're going to make it through retirement. You're not you can spend $100,000 a year for 30 years, and you're all right. It's not. It's I think you're So I certainly have. I have sympathy for saying I think people with who have $3 million plus shouldn't get massive tax benefits. They should just pay normal tax they would have paid if that's what they were earning in their normal. They shouldn't be penalised for it for having money, but they should just pay normal tax rates. You shouldn't give them all these efficient ones. But on the flip side, I feel like taxing unrealised gains is it's a dangerous path, because then all of a sudden all you do is you just create a market now for people who are good at doing dodgy valuations and unlisted assets. And I can have a house that's worth $5 million, but I've got somebody who can tell everyone it's only worth $1 million, and so that you end up with the honest people end up paying more tax than the dishonest people end up managing to avoid it, because they're the ones who are happy to find the dodgy people to do that. So anyway,
and of course it's 3 million now, but next year they're like, oh, maybe we should drop it a bit and drop and then with inflation, of course, more people fall in. So you can see it's a slippery slope, which I think it's a bad slope to go on. But I do agree with you that the tax breaks within the superannuation environment are over generous for those.
The big one I always talk to people about is so somebody who's not working, somebody who's working part time or something like that and earning $20,000, and they're being forced to stick away $2,000 or $2,200 into super, is effectively getting taxed. They had to take that money, they would have got 0% tax, and they're paying 15% of it. It goes into the whereas somebody on 500,000 who earns another 20 grand would have lost half of it. So would have had a tax rate of 50%, but now they're only losing 15%. They've got this huge pickup. So you're basically taking the poorest people and saying you're going to pay more tax, and taking the richest people and saying you can pay less tax. So yeah.
And Jason makes the point, of course, also that if you start using the unrealized tax, the point is values might go down. If they go down, then you've got to unscramble it. So it can become a really messy situation very, very quickly. It's just as another observation which is worth thinking about. Now, as we come towards the end of the show, let's just put up the gold slide. This is the price of gold at the moment, which is the gold futures at 2350. It's interesting. It's sort of been on a bit of a tear from March up till the middle of April. It's come back a little bit, but there is an interesting story that I think it's worth just exploring a little bit here, because the truth is that gold is on one hand seen as a secure, safe haven, although it doesn't actually provide any great returns. But there's a few things going on, isn't it, which is worth exploring, I think.
Yeah, I've got one as well. I'll pop up, which is just the guys who are buying a chart just showing the purchases by central banks. Now, for me, gold is about you're getting in front of investors or central banks if that's your goal. And you can just see that huge jump once Russia had its central bank assets frozen, is that all of a sudden central banks all of a sudden want this. And so I do think for the next, number of years that the biggest factor of sort of going for gold is, a central bank is going to keep on buying this. And so there's a little bit of a circularity in this in terms of saying, well, which are the central banks that are most likely to be buying gold rather than other assets? And you sort of might go through a few, Russia and China and, Iran, people who, and there's probably another number of countries, say in the Middle East and things like that, who have got a weaker relationship with the US, say, and are worried that they might do something that might end up wanting the US to freeze his assets. And so in a way, I sort of feel as if when commodity prices that benefit those countries are going up, you probably find the gold price going up because they're recycling it back into gold. So there's that part of it. And then there's the part about, what are investors doing? And are there investors in countries that are trying to get money out that might want to be looking to try and use this? So say you're in Russia and you would like to try and, you have a small fortune there and you'd like to try and get that overseas, is that, there's a benefit with using gold to get that, because it's very transportable. So I think while there's heightened concern between countries, and there's sort of this baseline demand for gold, but I think that's your key is sort of keeping an eye on what are other investors doing and what are central banks doing, because the fundamentals pretty much don't matter on that basis.
Yeah, and this is interesting that if you look at China, for example, because the Chinese central bank has been acquiring gold, but also now because of the fact that the Chinese economy is a bit wobbly, evidence suggests also that quite a lot of retail investors in China are also now accumulating gold as well and paying quite a lot over the odds for it, because compared with some of the other options that they have, it appears to be a
property
little
market
more,
and a stock market that's not that big and has been pretty weak as well. So
yeah, exactly. So that's another understanding. But as with this story about gold, I suppose the theory is that if things go really, really pear-shaped, then gold is worth something. I'm not quite sure what it is, but then you can't eat gold, can you?
No, you can't. And also, if the world goes to, if you're buying this for, there's some good books out there on gold. I'm trying to remember which one it was. But yeah, the good point was saying, look, if you're buying this because you're worried about the breakdown of society, and there's a genuine case in terms of saying, if this is one thing, I want to make sure that if something happens and society breaks down, that I can still afford to do things. Owning an ETF, gold ETF, isn't going to help you at that point. Or owning a gold bar is, if you take a gold bar down to your local shops to buy, you just painted a rather large target on your back. So yeah, it's a question. If you're doing it for those purposes, then at least buy the gold that's actually going to be useful in terms of those. And I think his tip was that when you look at societies that break down and war and things like that, you want things like gold rings and coins and stuff like that, where you can take it to your local store and, it's my grandmother's ring. I know I've had 3 grandmothers in the last week, but they've sold this for, and so don't think of my house as a target. Yeah. So, but
exactly.
I think I think for gold, the main thing I would just keep having people keep focusing on is central banks and other investors. It's a greater fool investment in a way. And actually, probably the other third one I'd put is the US dollar. They're going to be your big drivers. But the two ones, if you're buying it because you want to stay in front of other investors, then and you realize that, and you realize when other investors turn, you need to be clearing out as well. Then that's fine. If you're buying it because you're looking for an anti-US dollar, I have more sympathy for you. But if you're buying it just because, then I've got less sympathy. It's you need to know why you're buying it within your portfolio.
It's worth saying, of course, that the US dollar is still the best dirty shirt, right? So it may not be perfect, but there are other currencies that are doing a lot worse than the US dollar, and it still has a significant place at the moment, despite BRICS and everything else. And I've always believed that the significant conversations on social media about the US dollar is about to sort of explode and disappear, is overdone dramatically because of its place and because of the fact that a lot of trade is still done in the US dollar, and the central bank and the US government have a lot of control over what's happening with the US dollar. And I know there's a lot of euro dollars which are less easily controlled, but they're sort of connected. So to my mind, it's still the best dirty shirt.
Yeah, that's right. And look, you see stuff about contracts being priced in yuan, and so the question about is this mean that they're going to you don't have to worry about the dollar? The US by doing this by seizing these Russian assets, the US has sowed the seeds of its own demise. Now nobody can trust the US anymore, and they're all going to be trading in these. And when you look at it, you're like, really? You're worried about the US seizing your money, but you're not worried about China taking it if it happens to be in China's best interest, or Russia taking it. It's like, there's you sort of need to look at the alternatives. And the biggest one though as well is most of the world economy is in developed markets. So you add up the US, Europe, US, Europe, Japan, Canada, Australia. Pick a few other ones that sort of sit around, Singapore. That's most of the world economy, like in terms of dollar cents. So there's these smaller parts they talk about. Well, Brazil's, Brazil and Indonesia and places like that. They seem like they might be big, but in a GDP sense, they're really not that big as an overall flows. And so and I think they talk about the BRICS as being this idea of, maybe the BRICS it's a new growing group, and it's going to be it's a competitor to the US over the longer term and all that stuff. Well, the countries within it don't really like each other that much. Generally they like one of the other BRICS, but not the other ones. And so they're more kept together by an opposition to the US rather than any real strength within that group. And so I do think there's you're absolutely right that the thoughts of the US dollar is overdone of its demise, and the question about you can't be a reserve currency forever. Reserve currencies change. Yeah, absolutely, they change in periods of 100 years though, and the US has been a reserve currency for what? Well, which of the wars it flipped from? So maybe 100 years. If we might have 200 or 300 years left of it. So sure, you might not be there, but it's at the moment. It is hard to come up with something better. And the real thing with all these is that some countries certainly so Russia obviously has got its problems with the US in terms of seizing all its assets, but for most individuals, you want the rule of law, and so US, Europe, UK, Australia, Japan. There's a few countries there, and that you want to have your money in, and most of the alternatives that get discussed are not really. The rule of law just doesn't apply, and Bitcoin's a great example. There's no rule of law in Bitcoin. If your money's gone, it's gone.
Yeah, although it looks as though the investors in the Bankman-Fried empire might get some of it back, so we'll see about that.
I'm not sure they're getting as much as they'd like to get back, though.
No, I think you're probably right. Well, as we come to the end of the show, Damien, what are the 2 or 3 things that you've got on your mind in terms of the next 2 or 3 months as we go forward? What are the things you're watching out for?
Yep. So I think the main one within Australia is all these private surveys that we spoke about earlier being really weak. Is that going to flow through into sort of official figures at some point? And that's probably the key one within Australia. I've got a relatively keen eye on the US inflation this week. So that's out. Actually, I should pop up a quick chart on that one. I think that's going to be relatively key, certainly over the next month or two. I think I've just got the rents up there because I just wanted to highlight. This is from Macro Bond and Standard Chartered Research, just sort of showing they've got this line about what did rents do in the US, and just that last little tick up was quite anomalous, and that sort of helped. That was one of the reasons why inflation sort of surprised on the upside. And so the question is, if that's real and all these other rent things are wrong, then inflation does look like inflation is higher. But if that's just a 1 month blip, then maybe we might see a lot of this. We might see a lot of this the bond yield jump that we saw. That might unwind quite quickly. So there's those two. So that's Australia world for that. And then I'm still watching sort of world growth and trying to work out when do I think earnings will genuinely bottom. I don't think the market cares about it anymore, but for my purposes, I'm genuinely interested, because if it's an 18-month run before earnings truly bottom, then we might be looking at sideways markets or trending markets up a bit, down a bit for a while. If it's 6 months before they bottom and start taking off, then that's the markets can rise much earlier.
Absolutely. Well, Damien, I want to say thank you very much. Really enjoyed the conversation as we've explored some of the critical landscape features of the markets over the little while. And I think it's a very interesting time. I think there's a lot of uncertainty out there, and a lot of externalities can have an impact on the market. But as with always, if people want to know more about what we do through Wealth Funds Nucleus Wealth, there's a link below, whattheworld.com.au, and you can go there and find out a lot more there. And I want to highlight again that the whole point about the Nucleus Wealth platform is that it's much more transparent and agile, and provides a whole lot more information to investors than many. So that's one of the reasons why I'm very pleased to be associated with it. So links and things below.
Absolutely. And just the broad pitch is that we run both active and passive portfolios. You get all the individual stocks within it, and so you get to see that, but then you also get to customize. And so some of the latest stuff we're doing, you can both add and subtract. And so, great example, we had an exec we were talking with recently who has lots of shares in the oil and gas sector. Right, so let's have some. They just want a passive portfolios, but let's give them a passive portfolio and cut out all the oil and gas, because they've already got plenty of shares in their own name. And it's that type of thing. It's all about that transparency, because we understand you've got other assets and a place like that, and we want to try and work with what else you have around.
Hence Nucleus Wealth. Perfect
exactly.
title. Thank you very much, Damien. Really appreciate it. And we'll do it again. I'll need to figure out when. I'll drop you an email on terms of the date, because we've sort of knocked forward a week or two, and I've got a few other things on. So I'll figure out the next one, but I'll let you know. But we'll get you come back on again, and we'll also try and get David to come on and talk about the gas and energy situation, because there's a whole lot of
his soapbox ready, and he's ready to bang the table.
A lot of ranting to go on there. Thank you very much. Yes. I'm going to take you off stream, and I'll close out the show. See you later, Damien. Thank you very much. Okay, folks, I've enjoyed that. Always interesting to catch up with Damien, and lots of interesting points there. Next week, we've got Edwin Almeida coming on a Tuesday for a live show, and we're going to specifically discuss the question of how to prepare a property for sale. What are the steps to go through, and what are some of the considerations in terms of who to get to run the sale, auctions versus not, and dressing the property and all those sorts of things. So hope you'll join me for that, and I'll look forward to seeing you then. And just before I close out the show, the dog is hardly moved. Well, Luna's sort of out the market, so you've got half a Luna, but there you go. That's the girls there. And so thank you very much. Look forward to seeing you next week on the live show. Obviously, we put up recorded shows every other day of the week as well, so check those out. Thank you very much for all those who contributed via Super Chat. Really appreciate your contributions. Jason and a couple of others, I think, as well. So thank you very much. Really appreciate it. And I look forward to seeing you on the next show, which will, of course, be, next time around. I look forward to seeing you next Tuesday. This is Martin North from Digital Finance Analytics, signing off. Cheerio.